Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited that you're joining us today. Today, we are going to talk about the Smart Investor's Guide to Passive Wealth, how to balance control and freedom. Now, if this is the first time we're meeting, again, welcome. We do this masterclass live every Tuesday to help you learn how to turn your active income and savings into long-term passive income and wealth. So maybe you've tried to invest in passive real estate before, but just couldn't get comfortable making the investment. Maybe you've actually done a deal before and realized, oops, I made a mistake because I invested in a deal that doesn't match my goals, risk, and timeline. I just didn't know what I'm doing. I invested because my buddy did it. All right. Or maybe you're just simply needing to brush up and sharpen your skills. If that is you, you're in the right place. Now, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And what I get to do as my job, and I totally love it, is spend time with you, the investor, helping you understand the ins and outs of passive real estate so you can go into your first or next deal with confidence. Now, it's not like I'm just kind of a talking head here at passiveinvesting.com. I've actually done the investing myself, both actively and passively. I've scaled over an $800 million real estate portfolio with both active and passive investments in it. It comprises of residential units, self-storage units, express car washes, other business assets. I've done over 5 million in real estate fix and flips. And I live and breathe this. I coach this day in and day out. I also have my book, Money for Tomorrow, How to Build and Protect Generational Wealth, which you can get on Amazon.com or on Bigger Pockets if you want some additional resources. But everything that I do here is to help you understand how to get one result, and that is 100% control and choice on how to spend your time. All right. Now, you may have no desire to leave your day job or to step away from scaling your business. That's totally fine. What we are trying to help you do is diversify your portfolio. That way, if you wanted to do those things, you could. And we can help you do that here at passiveinvesting.com, whether that's investing through our equity investments like multifamily, self-storage, express car washes, or through our note investing like our PIC real estate debt fund and other promissory note opportunities. Now, if you're interested in learning more, make sure to register for the Passive Investing Club. You can go to passiveinvestingwithwhitney.com or scan the QR code on your screen. There, we'll hop on a one-on-one call to discuss your investing goals and how we can help you achieve them there. And you get a bunch of extra educational resources and priority access to our open deals. Now, we're going to dive into today's content information, but as always, this is not financial advice, legal advice, tax advice, it's education. So make sure you take this back to your investing team prior to making an investment. Now, today we're going to talk about all the different ways that you as a passive investor can actually balance control and freedom. Now, I know, and I was in the same boat years ago, as a looking as an active investor in real estate, owning, over 40 single family properties, having a partnership in a multifamily building. And I'm like, why on earth would I ever invest in somebody else's project? Okay. I was like, I can do this all myself. Look, I can like burn the candle at both ends and 5 times in the middle and run myself ragged. Okay. Today's goal is not to convince you not to invest actively. Today's goal is to help you understand how to balance control and freedom by taking an active approach to passive investing. So if you're that active investor, if you like getting your hands dirty, this is for you, because if you've been kind of curious but not able to really pull the trigger on an investment, we're going to help you understand why passive investing works, even in the most challenging markets. How can you stay in control while freeing up your time? And what do you need to do to confidently build wealth through expert operators? All right, so let's dispel a myth here. The first myth I want to dispel is we call it passive investing, but really what I teach people here to do at passiveinvesting.com, and also in my own coaching, is how to be actively passive. Okay. I want to dispel that myth. Okay. This is not a set it and forget it approach. I teach you how to stay in control. Okay. Because the reality is here, passive investing means taking a strategic, active steps up front. All right. How many times have you talked to somebody, or maybe you did this yourself? Okay. You invested in a deal because you saw somebody super smart that invested in a deal. And if they did it, they probably did all their vetting. So you're going to invest in a deal too. Or maybe you're just like, well, I'm going to pay somebody other to do the vetting. And then, a year or 2 years later, you realize, wait a second, either the deal just completely collapses and goes sideways and south, or you realize, whoa, my buddy and I had two different goals in mind. So that asset works for them, but it doesn't actually work for me. Okay. So that's what I mean. Passive investing is strategic and it's individualistic, which means you have to learn how to vet your own operators, vet your own deals, and stay informed about your portfolio. Okay. Just because you're investing passively doesn't mean you give up all control, because you have key control over the key choices that are going to determine what investments are right for you. Okay. So why be an active passive investor? Okay. Why are we like learning all these skills? Well, quite frankly, just in the last 2 years, what the markets taught us, that we as active passive investors need to keep our eye on the ball when we're, assessing a deal. We need to make sure that, that it isn't subject to interest rate increases, that it isn't being underwritten on very thin margins or compressed cash flow, and that what we need to have a forward-looking projection, right? Trust but verify the operator's underwriting, but making sure that the operator is actually taking a look at like what volatility could happen in the next 24, 48 months, maybe even 60 months, while the asset is during the whole period. Okay. Now, here's the thing. You can do this all yourself and you're making all those key decisions. Or you're working with an expert operator that has the team, the knowledge, the time, the attention to fully manage this asset. Okay. So the expert operator probably can navigate these complexities that we've experienced in the last, 24 months a little bit better than most individual operators could. Now, we're going to talk about illiquidity and how it might actually be a good thing for you, not a bad thing when it comes to passive investing. And we're also going to talk through, how can we make sure to look at, how can we like suss out some more of those recession resilient assets that might provide stability. So let's dive in on the first, like why active passive investing is the smarter path. Well, for one, again, we've got that expert operator on our side to help us manage all the risk. They have the time and the attention and the team to look at all the different, long-term financing, fixed rate options, or if they're using adjustable rate, like how are they risk mitigating the market through extensions and rate caps. They're able to access larger projects and carry larger reserves than we probably could as an individual. And they're able to, have access to markets because of their team and how they structured their team, more recession resilient markets than we might as our own passive investor. Okay. It would be a little bit hard for us to break into the next market. Number two, we teased a little bit why illiquidity might be stability. Okay. Illiquidity, like anything, even interest rates, can cut both directions. Okay. But don't let the illusion of liquidity, substitute for getting into a bad investment. Okay. I see people do that all the time. Hey, I'm going to go invest with ABC note fund investor, and their note fund is 40 to 60% levered, but I could get my money back in 90 days or 30 days. Well, sometimes that's not the case, right? Because those terms can change. So illiquidity if you underwrite an asset properly in the operator, in the market properly in the beginning, okay, if you take all those steps as an active investor, okay, that illiquidity might save you from making some pretty rash decisions or making some decisions based on return metrics alone, okay, which in the end of the day can actually help you preserve your wealth. Now, number three, take advantage of, tax advantages can be very powerful, right? When you invest into larger deals with larger operators, it's easier. You can do it yourself. You can do a cost segregation and take accelerated depreciation and bonus depreciation on an asset. Totally fine. You can do it yourself, but it is a little bit more expensive and more complicated to do so, more complicated to navigate. It's easier to do that with an operator who's investing into a deal. And what's even easier is upon exit, that operator is going to be able to probably better navigate a 1031 exchange. Now, if you're a high net worth investor, okay, you probably have a higher and better use with your time. Maybe, you're a tech worker or a doctor or a lawyer or engineer or run your own business. You may not have all the time in the world and the network available to navigate all these complexities. Okay. And then here's my favorite part of being an active passive investor is that I can actually create a more diversified portfolio than I ever possibly could on my own. Okay. I can invest in multiple operators across multiple markets, across multiple deals, across multiple layers in the capital stack, okay, in multiple asset classes than I ever could. So I could create this greater diversification, okay, that is going to help maintain my wealth and probably even grow it. Right. But all those things that we just outlined are nothing. They don't count if we don't, as an actively passive investor, learn how to do proper due diligence. Okay, so if you're somebody who's sitting on the fence, like, I like the idea of passive investing, but why the heck I do it? You have to get really good at one skill, and that is due diligence. Okay, underwriting the operator, underwriting the market, underwriting the deal. Now, we do our boot camps on a regular basis, and we're about to start launching into our underwriting parts of our monthly boot camp starting in February. So you're watching this video at the perfect time. But you can go to our youtube.com page and look up all of our due diligence videos on how to underwrite operators. What are we looking for in a proven track record? What does transparency really truly mean? Okay. How do we assess markets to be in? Okay. For me, I'm looking for markets that have stable job growth, population increase, crimes coming down, poverty is coming down. We're also got good tax laws in place. Maybe even right now, we're taking a look at insurance costs in these various markets. Okay. And a host of other variables. And then the deal itself. And unfortunately, this is where a lot of people go wrong, is that when they start looking at a passive deal, they start looking at the deal itself and then trying to make the operator in the market fit the deal, fit their goals, fit the risk, fit their timeline, as opposed to answering all those questions up front and then finding the right deal for them. Okay. Again, the key takeaway here is strategic due diligence will put you in control of your passive investments. Now, I wanted to give you a little case study here because, oftentimes people say there is just no possible way that somebody can achieve, their possibly their long-term goals with just passive investments alone. It can be done. I am not saying that that's what you should do. Just because you could doesn't mean you should. But here is somebody in our network, an active investor, or used to be an active investor, managed a pretty large single-family rental portfolio, had some high returns, but the cost of that time, took about 10 hours a week to manage that portfolio because of tenant issues, and then they had tons of capital expenses on top of that. Break-ins, stolen HVACs, stolen water heaters, and these were houses in good markets. Now, when they decided to start diverting a a sizable chunk of their portfolio into passive investments, some cool things happened there. One, they were able to get into larger assets that were more stable. They were able to earn a preferred return that threw off some cash flow, all right? And they were able to reclaim a lot of time in order to travel and focus on family. Now, if you're sitting here listening going, wait a second, but cash flow right now is a little compressed. It is, but it's compressed in a lot of different phases of the market. Okay. But we can create freedom in a lot of different ways. We can do it through equity. Okay. Or we can do it through note investing. That is kind of my favorite investment right now in this market. This is what the market is giving us. This is where we're at. We're moving through hypersupply, recessionary part of the market. Okay. I think people are really hopeful with the interest rates coming down that we are moving into growth part of the market, but we're just not quite there yet. But even with just like $100,000 annual investment into a note fund that throws off at 8 to 9% preferred return, and if you continue to reinvest your profits for the next 5 to 7 years, you're going to be able to close. You're going to create a nice stream of income for yourself. Right? So the whole point of today was to help you understand how to remain in control of your portfolio as you consider moving from being an active to passive investor, or maybe just adding in passive investments to your active portfolio. Okay, so I'm going to give you a quick little cheat sheet here. Feel free to take a screenshot, but to become that active passive investor, okay, we have to answer some questions for ourselves. Make sure you understand why you're investing, your goals, your risks, your timeline, what your diversification you need, right? If you need additional resources for answering those questions, you can go back to our youtube.com page, or you can reach out to me at whitney@passiveinvesting.com and be happy to hop on a call with you. You can become more proficient in due diligence. We're about to restart our underwriting series on operators, markets, and deals within our boot camp. So make sure you're on the list for that. And then, as you find investments that match your goals, your risk, your timeline, that you have fully vetted, then that's when you can kind of take your foot off the gas a little bit, but stay in tune and make sure you're properly tracking those assets, meaning that you're reading the monthly reports, understanding the quarterly financials, asking any questions. That way, you're not surprised with any changes with the asset. Now, we've talked a lot of things about what you should do, but why is the time now? Well, we are at that point in the market where it is kind of good to be studied up on a particular topic, because once we come out of the recessionary phase into growth and hyper growth, you want to be well prepared. That is not the time to be researching your operators and markets. We need to have all that work done. That is not the time to understand your goals, risk, and timeline. We need to have that work all done. Okay, so this current market condition actually presents us a unique opportunity for growth, getting prepared for growth. All right, guys, thank you so much for spending your time with me. If you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show. Awesome, guys. So what questions do you have? First of all, I got a question for you, as always. What did you like? What did you love? What would you have loved to see? This presentation was really geared toward helping people get into that right framework of how to be like a active passive investor. Okay, let's not think of passive investing as set it and forget it. Let's think of active passive investing as an active activity that we take on in order to get a passive result. Yeah, Happy New Year to you, Chris. Thank you so much for joining. What's the biggest risk in note investing? Okay, so we have to clarify here. So what I was discussing was note fund investing. So if we're just going to go note fund specifically, or excuse me, note, it's going to be similar to being an active investor. Like if you're originating all your own notes, you're going to not be as well diversified across, borrowers, potentially markets and deals. Okay. So, if that individual note investing, while it is technically passive income, meaning it comes in passively, you're taking an immense amount of active work to do it. And you, which is fine. If you have the bandwidth and the love and the drive to do that, do it. If you're like going, put together a note portfolio and I'm just going to kind of like be passive, like hands off. No, like think about getting into note fund. Okay. So yes, David, I'm getting to it, but I want to make sure that we level set because you asked the question about note investing. I want to make sure that we're talking about two different things, note investing versus note fund investing. So yes, if we get into investing in a note fund that like a hard money lender puts out, kind of like what we do with our rehab wallet hard money lender, we have the PIC real estate debt fund that the rehab wallet deploys into loans. So I have a whole like two-part video series that I did last fall. You have to underwrite the operator that's raising the funds and the operator that's deploying the funds. Okay, so that's, if I had to name one big risk, is that most people don't do both of those. They only underwrite one person, okay, which might be the fund, whoever's raising the money. So you need to underwrite both people. And then of course, we're gonna get down into like the borrower and, what is actually being lent on and all those different, metrics. And then the other big risk in there, and what I'm seeing in the environment is a lot of, I'm gonna get out of here so I can see the Q&A screen, is that a lot of operators actually take out a bank line of credit. So they take your money, go to the bank to get a line of credit to lend out more money. Okay, so they're leveraging the fund. Okay, we don't do that. We don't use any leverage in our fund. So that it can be a risk. Now, I think having, a 5-10% warehouse line of credit is totally fine. That's smooth, money coming in, money going out, right? Like, you're not stuck, having, if it's a smaller note fund, you're not having all the start and stop, but it's a slippery slope. Because I've seen note funds that are 20, 30, 40, 60% levered. Okay. And I think that's a real risk. They're using that leverage to juice returns. And I don't think the investor is really savvy to that. So go back and watch those videos because I did those videos specifically to help you as a passive investor truly understand what it means to invest into a debt fund. Okay, there's all different flavors of debt funds, just like there's all different flavors of ice cream, but also how to actually suss out all these like little things that could get you. Just because it's a note fund and it's technically at the lowest layer of the capital stack and low risk, low return, doesn't actually mean that it's safer than an equity investment if there's certain things there. Are note funds comprised of first position, hard money, or seller financing for, I mean, it can be anything. Note funds can be mortgage-backed securities. It can be on commercial real estate. It can be ground-up development. It can be secondary notes. It can be a blend of all of those things together. Maybe you didn't want to be exposed to ground-up development, but if you're in a particular note fund, maybe you are. That might be 40% of the fund. For our debt fund, we're very plain Jane, okay? It's hard money loans on fix and flip real estate that are 6 to 9 months long at about $160,000 each. First lien position only, okay? So it's on like generally a 3-bedroom, 1-bath, 3-bedroom, 2-bath house, like in the Southeast. That's like our bread and butter. We're pretty plain Jane vanilla. But there's different note funds out there, but you're just going to need to kind of dig into the specifics. I don't like surprises. I don't know if you guys know. I am pretty conservative investor. No, I don't like surprises. If I see a good deal and everything checks out, but the investor relations person is just not clicking with me, is this a red flag? Ooh. Um, Possibly. And the reason why I say possibly, I would kind of pay attention to that. I would ask to talk to whoever is because maybe you're talking to investor relation consultant. Okay. Maybe you need to talk to the investor relation director. Um, maybe you even need to talk to one of the managing partners. Okay. That'll give you some insight. But that consultant is either, if you're not clicking with them, you kind of need to listen to why. Like, are they new? Because people kind of have to start from everywhere. But if they're new, great. Then talk to the higher up and see if you're comfortable with them. Maybe they just need more training. Maybe they just need to be more, comfortable with, talking to people or that arena. Okay. And that's also something the higher up would want to hear. They're going to want to hear that feedback for sure. But if you start seeing that pattern all the way up the chain, that to me is kind of a red flag, because you want to have, you need to know, love, and trust the operator that you're working with. Okay. You need to resonate with them on some level. Could you invest in an asset and completely hate the operator, like not like them at all, and think they're kind of a jerk? Sure. But that you have to think about, like, if that would keep you up at night. For me, I listen to my gut a lot. I always tell, my investors, listen to your gut. Like, if it's saying no, then, let's listen to that. Let's or at least pick that apart and understand why. So, is it a red flag? Definitely a yellow flag, and we need to dig further for sure. Let's see here. What other questions do you guys have? Somebody said, include more case studies. Yes, Um, yes, we do highlight. If you're not on our newsletter list, send me your address, and we highlight all of our investors, or a lot of our investors, and just like all the different ways that they're using passive investing in order to amplify their life. And so, make sure you're subscribed to our physical newsletter. If you don't have that, email me, Whitney@passiveinvesting.com. Email me your email, and I'll make sure you get that. What do we think of a fund manager, and why should we invest with them? Okay, so I always like to start with what. Okay, what is a fund of fund manager? A fund of fund manager is somebody who can aggregate a larger check to take it to an operator to invest, but they have no active role in the deal. They're simply just bringing money. Okay. But when they bring the money, they're typically getting better terms for their investor and better terms for themselves. Okay. So they might, let's say I'm just going to throw out a situation. Okay. That, maybe they, if they brought like a $5 million check to an operator, they would get a 9% preferred return and a 80-20 split. Okay. When the deal is actually a 7% preferred return and a 70-30 split. Okay. That's a pretty good deal. Okay. I'm just throwing out spitballing here, guys. But that fund of fund manager is going to go, I'm going to give an 8% preferred return to my investor, and I'm only going to give them a 75-25 split. So they keep the extra 1% pref, they keep the extra back end split for themselves. Okay. Now, why would you go through the fund of fund manager or not with the operator? It's because you probably got better terms than you did than going to the operator directly. For me, I'm in the point of my investing career that I will always, unless there's just a super compelling reason, I'm always going to go to the operator, unless it's an access issue. If the only way I can get access to that deal, and that deal is super compelling, is through a fund of fund manager, then great. If it's because of returns alone, probably not. I want to be with the operator. Okay. If the operator is actually handling investor relations, I might want to be with them. Now, yes, it is meaningful to have that extra 1% preferred return. Maybe remember, preferred return is not a return, it's a hurdle. Okay. And it might be meaningful to have that extra back end split. But what's more meaningful to me is to actually have direct communication with the actual operator, that visibility, and not have that kind of, curtain in between. I do have a couple deals where I went through a capital raiser, and I really wish I'd gone directly to the operator itself. Fortunately, everything's going well. So, but that's why you would go potentially with a fund-to-fund manager, is potentially to get better splits and potentially get access to a deal that you otherwise would not get it. Now, if you're not getting either one of those or both of those, I'm not sure what the fund-to-fund manager's value they're bringing to you. I would love to hear in the chat box if you guys have other ideas, but those are the two. Those are my two criteria if I'm going to go through a fund-to-fund manager. Awesome. What are the quick questions that you guys have? We have time. They don't have to be quick either, but go to the Q&A box, get them in quickly. We'll hang out here for another couple minutes. Mr. Anonymous, I wish I knew your name. You got great questions. I love it. So so the question came in, do you think hold for a long term is better than sell at 2x in a few years? It all goes back to it depends. So let's level set those based on our conversation today. What are your goals, your risk, and your timeline? Okay. I'm just speaking of hypotheticals, if I'm a 20, 30 something year old, 40, maybe even in my early 50s, and I'm trying to hyperly grow my portfolio, holding for the long term with no clear plan to sell to where I can recoup my capital and redeploy it into another asset is unappealing. Okay. Now, that said, can the operator sell in say 3, 5, 7 years and hit an actual 2x multiple? That it depends. It depends on the market environment. I think you're going to start seeing 2x multiples over 5 to 7 years, not the 3 to 5 years, what a lot of operators were trying to promise, but that's still feasible. And the reason why is because they're using leverage, right? You're not having to double the whole asset value, just the equity stack value. That's it. Okay. So, now why would I want to be in an investment and hold long-term? I'm in a couple long-term investments that are in perpetuity holds. One, I kind of wish I wasn't. I wish I could get my money out of it. I can. I mean, there's certain mechanisms to which I could sell, but another one is just like it's a land bank investment. So I knew that going in, that I was not ever going to get my money out of that deal. Okay, it was going to be like the cash flow and whatever we could get through refinancing. So if you're okay with a long-term deal, make sure that it hits not only your goals, risk, and timeline profile now, but also in 10 years and in 20 years and in 30 years. Okay. Kind of put yourself forward. Okay. So if you're looking at a forever hold, go, okay, in 30 years, I'm going to be for me in 30 years, I plan on being fully retired, hopefully taking care of, I dare say grandbabies, but whatever, hanging with my family full time. Am I okay with that? Am I okay with the terms? And would I be okay with the risk profile, the timeline, and everything at that point in time? Okay, so make sure you kind of interview yourself in different intervals if you're going to do a forever hold. My guess is For some people, when they hit like late 40s and 50s, it's going to be, depending on their stage of investing, it's going to be somewhere between, quick turns at like 5 years and maybe holding on for like 10 to 15. Most investors, even if they own their own real estate, sell somewhere between year 10 to 15. The debt profile on the asset changes, and it's kind of time for new ownership, right? They've depreciated, they've taken most of the depreciation they possibly can on the asset. They've done, they're probably staring down a lot more capital events to come down at them. And so it's just time for them to reposition. So like I said, the timeline's probably a sweet spot for me is about 7 years. Okay. I think for a lot of people, it'll probably be somewhere 7, 10, 15 years. Why do some operators want to have monthly reporting and distribution, but some only quarterly? Are there any hidden cost reduction or returns for the monthly cadence? Uh, no, actually, it's more expensive to do monthly reporting. Yeah, it takes way more time, attention to do monthly reporting. If the operator has good system, and let me also put it this way, it's asset dependent. Okay, so if you're invested in a multifamily deal or a self-storage deal where income's coming in monthly, the the operator could probably do monthly returns. Okay, if they're only doing quarterly returns, that's not bad, but why? Right? Like, is it because they only have a part-time CFO and a part-time bookkeeper? Maybe they're not paying for a full-time, they don't have full-time staff to take care of that. That might be the reason. But it takes more time and attention and energy to do monthly reporting. Now, if you're investing in, say, like a cash flowing business, like, express car washes, the cash flow is going to be smoother over a 3-month period. So this was something we discovered with our express car washes. We were doing monthly distribution, and our investors were so confused because 1 month, like, it'd be super amazing, cash flow coming in, like, because from a summer event, and then the next month maybe we had like a week worth of rain, or if it were in the wintertime, we had like a freeze and the location had be closed down. It was closed down by the city because of the potentially freezing conditions, and then cash flow was paused. So we were like, start, stop, right? And so what we found is over a quarter, we can smooth that cash flow to the investors. Okay, we can smooth out operations a little bit more. I think that's totally fine for your businesses, like if you're investing in hotels, car washes, stuff like that. I can see why people do it with multifamily and self-storage, though I think those are much easier to do monthly distributions on. But it's actually more expensive to do monthly distributions than it is quarterly distributions. But here's the thing: what if we can, we will do monthly distributions to our investors. Why? Because we know our investors are looking to build their life off of the income that they can bring in from their investments. And most of us are used to a monthly paycheck. How many of us are used to a quarterly paycheck? I'm not. But I have investments that are quarterly, and so I plan accordingly. Awesome. Let's get one more question in here, and then we will wrap up for next week. Are your funds, such as the debt fund, audited by an independent CPA firm? So no, we don't do independent auditing. We do have our accountant that manages all the books, our outside accountant agency that manages the books, and then we also have our inside accounting team, and they reconcile every year, but we don't pay. I want to be very clear, we don't pay for a formal independent audit. Those are very costly. And for us, we just really haven't seen, because we have that dual system in place and all the checks and balances, between our rehab wallet team, our passive investing accountant team, and then also our independent CPA, we haven't really had the need for that. But that is, especially if you're looking at a fund where they're not vertically integrated, that means that the fundraising team, the person raising the funds does not have visibility into the operator's operations. I think that's very warranted. You need to ask for, independent CPA audit, right? And it's because you don't know what this guy over here really is doing. So for sure. If they're vertically integrated, what are their checks and balances and systems for sure? Ask questions about that. If they're not vertically integrated, absolutely 100% make sure that you're getting that the fund's doing an audit. What do you think of oil and gas investments? I don't think of them. Just kidding. Is it worth the volatility? So in all fairness, my family comes from oil and gas. And so I don't see a lot of these investments that are open to retail investors as being very fruitful. They're more for tax. How they're getting the asset, the actual asset, and how they're exiting the asset just boggles my mind. From my family was in oil. I mean, my granddad was in oil and gas, so on both sides. And then my dad was in oil supply, and and then my uncle was a mineral rights lawyer and estate planning lawyer. So I don't play in that arena. It's not to say that there's not good investments. I just haven't found one that was worth more than just the depreciation you'd get. And there's other ways for me to get the depreciation. Now, that said, I totally am down for an investor having some sort of exposure to energy sector. But how do you get that exposure? I'm really more about getting that exposure through stocks and bonds than I am through individual private investments. That way, in the stocks, you're getting exposure to like the big 5, big 6 oil and gas companies and the other ancillary companies there. I think that's probably a smarter play, unless you're going to get super duper savvy about this. Cool. Well, guys, I'm happy to stay on. If you guys have more questions, dump them in real quick. But thank you so much for spending your time, not only with me here today, but investing it in yourself. As always, we will have another session next Tuesday. And then this month we tried something new. You will be getting our passive investing boot camp, where we talked about how to calculate your cash flow for retirement. 72% of you guys are doing it wrong. Okay. That's a statistic that I pulled. Anyways, most people actually calculate their numbers for retirement incorrectly. I walk you through how to calculate those retirement numbers, how to look at how inflation plays into those numbers, and then more importantly, how to look at what you need for retirement. And so take a look at that boot camp. Would love to hear your questions back from that. And, like I said, we're testing actually just giving everybody the tools opposed to, having 2 sessions in 1 week. All right, guys, take care, and we'll see you next week.